Okay, we'll go ahead and get started. Welcome, I'm Dan Siciliano, the Faculty Director of the Rock Center for Corporate Governance here at Stanford. It's my pleasure to introduce this panel. They're going to be talking about corporate spin-offs and splits, the quote-unquote governance considerations for the board. Without wasting any time, I'm just going to hand it over to John Thompson from Heidrick & Struggles. We're really happy to have John here. He's a longtime partner at Stanford in many capacities, including at CEPR, the business school at the law school, but in particular with the Rock Center. He serves as, and I always have to make sure there's a lot of important title here, and I wanted to make sure I get it right. He serves as vice chairman of Heidrick & Struggles Global CEO and board of directors practice, based both in New York and in Menlo Park. I think it's based in Menlo Park because he wants to be in Menlo Park, and this is the center of a lot of exciting activity. He is, in short, one of the best known and most respected players who place CEOs, board members. If you ever need to get connected with someone in a high-ranking place, call up John, and with one quick dial, I think he can connect you. So with that, I'm going to hand it over to him, and I think we're going to do some quick self-introductions, and we'll go. And as is our custom, we'll run till about 7:40, 7:45, or 6:40, 6:45 with conversation, and then switch it over to questions afterwards. Thanks very much.
Fabulous. Well, it's a pleasure to be here. Thanks, everybody, for agreeing to come in and participate in the discussion. And what I'd like to do is start on my left with Heidi Fields and have everybody give just a quick introduction.
Okay, hi, my name is Heidi Fields. I'm the retired CFO of Blue Shield of California. And I think I was invited, not just because I know Joe Grunfest, but because I have a lot of involvement with spin-offs. I was the first CFO of ITT Industries when it spun out of ITT in 1995. I joined the board of Agilent shortly after it was spun out of HP, and it recently spun off a major business segment called Keysight. And I just joined the board of Halyard Health, which is a spin-out from Kimberly-Clark.
Nancy Wojcik, I'm a partner at Cooley, which is a law firm in the Valley, and I co-chair the Public Companies Group.
And Ron?
I'm Ron Gilson. I'm on the faculty at Stanford. I teach a course in acquisitions, teach a course in deals. But in terms of this panel, I suspect my greatest use is I'm the board chair of a mid-sized institutional investor who, for most of these companies that we observe, we're part of the stakeholder group.
Great. Okay, thanks. It strikes me that maybe a very useful definitional exercise here could be very important, because I found the business press uses interchangeably words like separation, splits, spins, and for example, Hewlett-Packard, which we have some expertise in the room here with Raj being of counsel to Hewlett-Packard with their separation that's currently underway. The press has called it a spin, a split, and there are some definitional issues. So maybe, Nancy, you could give us a quick snapshot of what you think is important in the difference here.
Okay. So when you think about separation transactions, you need to think about it in two ways. One, the board decides to, in effect, separate a business unit to someone else. And it can be effected through a sale to a third party. We're not talking about those today. You do those every day of the week. The second way is a sale or distribution of stock in a newly public company, and that business, in effect, is separated, much like HP is doing with its company. So there are three terms I'll define: spin-off, carve-out, and split-off. A spin-off is the parent firm distributes the shares in the spun-off subsidiary. There are two independent companies at the end of that transaction. It's usually done in a form of a dividend, and it effectively removes the parent from the spun-off business. And again, there are variations of all of these transactions, so I'm just kind of giving you a general definition. There are tax implications that you have to be incredibly careful about if, in fact, you want it to be tax-free. There's a carve-out, and that's where the parent firm sells a portion or all of the shares of the subsidiary in an IPO. and the current shareholders of the parent don't receive anything. Again, variations of that. Split off is where the parent company shareholders are offered shares of the subsidiary in exchange for the parent shares. And in that type of a transaction, the shareholder must decide between the new company and the parent. And it's kind of a modified parent share buyback. So those are the three terms that I'm most familiar with.
Yeah. Ron, your observation here, and maybe one of you could talk to, what if you sell a part of the company to a PE firm, for example? How would that be categorized? Anybody have a...
I wanted to just I want to be clear about what the categorization effort is about. So one part, in the way Nancy's done it, makes it really clear there are different hoops that one has to jump through. There are different tax consequences. We can imagine choosing which of these techniques we're using following a decision about splitting it off. But playing the institutional investor for a second, are there any consequences with respect to the post-transaction value of the spun-off entity or the parent, depending on which of these categories we use? And the example, one example where it might be the case is when we distinguish between a partial or a full carve-out, because the difference between partial and full is you're changing control of the company. Typically, in a partial, the partial will be a minority. It'll be a minority sale, and the basic control structure of the company stays the same. In a full carve-out, you're changing the control structure, and at least we may have intuitions about the difference in post-transaction value as a result of the control shift. So I guess I just want to separate the categories between ones which have value consequences, where we imagine that the companies will be worth more or less depending on which structure we use, and categories where we're talking about the extremely difficult but still pretty value neutral exercise of making these the hard work of making these transactions actually come off.
Heidi, any observations on these definitional steps here at the beginning of a conversation?
Well, no, not in terms of definition, but I mean, at least from my standpoint, from the seat I've been in before, is that what you choose is just a practical selection based on picking the best avenue. I mean, the real challenge is figuring out whether you want to do it or not, and that's just a natural evolution, I think, of the strategic portfolio process, and the board has an ongoing responsibility for overseeing that.
In terms of, I tried to find some historical data here, and I did find some, but let me preface the next question I have. Spinoffs have grown in popularity certainly over the last 20 to 30 years, and they're increasingly a larger part of divestitures, from about 10% in the 80s to approximately 50% in the 90s, and the number for the 2000s and beyond here is likely to be north of 75%. So spinoffs have really ramped up in the last couple of years, and I guess the recent Deloitte study I saw said that they expected that in 2014, when everything's tallied, it'll be over $775 billion in value just that year alone. And a lot of this has obviously been caused by increased shareholder activism, whether it's from hedge funds or Carl Icahn, the Bill Ackman, Dan Loeb popularity contest, or whether it is from increasing institutional investors such as Vanguard and BlackRock, who have recently made statements that they want to be more assertive in terms of impacting corporate governance. Very long-term tenured directors that don't attend meetings or have a poor attendance record. So I think BlackRock just a few weeks ago made some formal statements about that. So with regard to that, in terms of a background, what's the What's the cause and what is the activity in Silicon Valley? Because that was the title of tonight's session. Is the spend factor in the Valley. What's happening now? Ron, maybe I could let you start there. Of really, what's the cause of the activity in the Valley as you see it over the last year, a couple of years especially?
Let me start with an explanation that Heidi may have a better sense on, but I want to separate out the activists for a second, which is to say that businesses run cycles. Businesses grow. The synergy that you had in mind when the companies came together the businesses evolve separately over time. You begin to have a sense that you're losing. There's less advantage to them being together. You're diluting incentives and the like. And in a board who's doing what Heidi describes, which is managing the company's operating portfolio, come to a conclusion that it's time to separate them. There's more value associated with the companies being separate than they are together. Great, one set. A separate set is the activists, and this will be true of Silicon Valley and every place else. Remember, the activists cannot force a transaction unless they get a majority of the voters to go along with them. They can't replace the board without winning a proxy fight. And in turn, if you look at the institutional distribution of shareholdings in the Valley and elsewhere, you're largely talking about the institutions. So one way to think about the activists is that the change in the distribution of shareholders from individuals to intermediated equity is that the activists have an audience whose function is simply which way is the company worth more? Is the spin-off going to increase the combined value of our holding? They both serve as an invitation to the activists because they're an audience for the proposal, but they also serve as a constraint on the audience. If you look at the very large mutual funds, the percentage of time they vote with activists is quite different. BlackRock's on the high side at around 50. Vanguard's much lower, with Fidelity somewhere in the middle. So if you want, on the activist side, as opposed to the board responsibility side, I think the biggest shift in the Valley and every place else is the intermediation of equity. That is, who the shareholders really are. They're not individuals. They're sophisticated investors, and they're perfectly willing to listen to proposals and make a judgment about whether they think they're going to create value or not.
But that's been the shift, hasn't it? A shift of they're actually listening to the hedge funds now, as opposed to a few years ago where, they weren't getting quite the respect, or at least some of the activists were not getting the respect that they felt they deserved when they approached the institutional investors.
Well, let's remember that lumping activists together is a little bit like describing people as brunettes. It's an accurate story, it's an accurate statement, but it doesn't tell you much about them. There are people who have track records of decent ideas. There are people who are relatively new in this business and don't. But remember, if you're talking about an institution, you're talking about a portfolio manager who knows the company, who knows the industry, and is astonishingly incentivized to create value within their organization. So they are going to listen, but they are going to make up their own mind, because let's remember, the ISS story. My guess is there isn't anybody at ISS that a major fund would hire as a portfolio manager. So on these kind of transactions, nobody's taking their advice.
Are there any special fiduciary responsibilities on part of board members as you contemplate a split? Ron, are there fiduciary responsibilities that would make sense to discuss?
As a general principle, I don't think they're any different than making business decisions all along. They have an obligation. To do a good job. They are protected by a standard, the business judgment rule, which means unless you do an absolutely terrible job, no court is going to give you any trouble. But the basic standard is the same. There will be circumstances in particular transactions where there is an issue about the role of a particular executive or not. But those will be focused on, in my sense, those will be focused on a particular idiosyncratic fact pattern, nothing general to the transaction.
But the focus is the parent stockholders, not the spun-off company's stockholders. So it's up to the board how to deal with, what assets go, what liabilities go, and the focus will just be the parent stockholders. And Heidi, I know you have a strong view on this.
My experience was a little different than that, because we felt that for the transaction to be successful, the spin-off company had to be a successful company. And I think there's some good logic to that. You're doing this because you want the parts to be greater than the previous whole. And that's only going to happen if you've got a successful spin-off company. And so we actually were very, very diligent in how you split the assets and liabilities, how you split the technology, or maybe overlapping patents or shared patents, how you do the transition services agreements, and also in terms of tracking whether they have leadership in place of the spin-off company, whether they have their financial controls in place, whether they have their technology in place and tested so that they can actually run well as an independent company, because it isn't a no-brainer to separate two entities that have been connected for so long. And so that whole issue of readiness is, I think, an obligation of the board, and not just readiness, but that it's a pretty darn good standalone company when it gets spun out.
Well, I think overriding all of that is you want to make sure that the spun-out company doesn't become insolvent immediately. That's a concern that the parent board should be concerned about, as well as tax implications. So there are some overriding things that you have to be concerned about, but ultimately your duty, if you're on the parent board, is to the parent company stockholders. And I had one company who they had really a dog business in another country, and they kept going, Nancy, it should be spun out. I'm going, now, what shareholder would want to have this company? How would you ever justify this other than let's dump it, And they went on this path for a long time, and they finally figured out that, this is just not going to work. No one's really going to want this thing. So we ultimately sold it to a third party who, God knows why they bought it, but they bought it, not our problem. We have a few indemnification obligations, but we're not talking about that deal.
Good. I know, Ron, you alluded to this a little earlier, but what's the role, how do you see the role of a large institutional investor changing, especially over the last couple of years? Is there a tsunami of change happening, or is this a very gradual change?
I actually think it's happening. I think it's happening fairly quickly, because we come back to the activists. The activists that are catalyzing the institutions. It's unlikely, except in unusual circumstance, for a large institution to itself proffer a directed change in company strategy. So they will be reticent in the sense that they will not be pushing themselves changes in strategy. But if an activist brings them a proposal which says, look, here are my 300 slides. I want to show you why the company taking this action will increase value. They'll listen, and the more money the activists succeed in making, the more entrances into that industry there is, and the more attention that gets paid to them. But in the end, the institutions have the capacity to intelligently respond to whether the proposal makes sense or not. the activist the catalyzing role of the activists is, I think, central to the process, for better or for worse.
And I actually think that the activists or the institutional investors are showing up a lot earlier than they previously had. You usually didn't get institutional investors banging on your door unless you were seriously underperforming. And now it's really more, they see an opportunity to outperform, to do better than you have, but you don't have to be a dog of a company anymore to have an activist shareholder show up at your door.
Yeah, you look at that, you're the underperforming, if you're performing less than the 50th percentile total shareholder return, but you see Carl Icahn, Bill Ackman at Apple, with a company that's been just crushing it. And they want to dividend back some of this cash. Last time I saw, they have $180 billion in cash. And a similar situation happened at EMC with I think they own about 80% of VMware. And Elliott Management in New York came to them with a proposal that we wanted you to make some changes, and they put forth a very thoughtful approach. I think it was not a crazy approach. And there's a big difference between, as you said, between activists. As you said, they're activists. Carl Icahn puts his own people on, and so Bill Ackman does that. And then people like Elliott don't put any of their employees on. They have independent. They recommend independent board members, so that are not paid by them. So there are major differences in how these things how these things come down today. And you saw this morning, was it Harry Wilson? That was involved in the the bankruptcy of GM went forward, and he only has $1 million worth of stock, so he doesn't want a big fund, but he got four investors that own about 2% of GM to demand that they dividend back $8 billion in stock, and he would go on the board. If they didn't, he would issue a proxy contest. So things have changed very rapidly. And you saw what happened. GM said we're going to do it initially. We need $25 billion in cash to operate their company within the limits we want to operate it, and we're going to dividend back at least $5 billion. And they didn't specify the time. As I saw this afternoon, they didn't specify any time. But Mr. Wilson withdrew his interest in being on the board because they made that concession. So the things are changing quite rapidly. The next question I had here is, what suggestions do you have about shareholder engagement once a board has decided to go down, the road of a split? And maybe, Heidi, we could start there with you, because you've been through two of these, once as a board member, once as CFO, correct?
I joined I joined a CFO after their spin.
After the spin, so
Yeah.
but you've seen.
So I lived with the consequences.
So you
of
live with
what
the
my
consequences,
predecessors
but how about shareholder engagement once the board has decided that? Are there any guidelines or suggestions you would have from your observations?
No, I mean, I think that the way you go about engaging shareholders is the same as you do normally. Your methods of communication and your investor relations activity, I think it's obviously a lot more focused on a particular major corporate event. You visit major investors for that special situation. The CEO is involved more than he typically would be. You take a lot more visits. You can expect a lot more visits. I think that you've got to make sure that I think the board has an important responsibility in making sure that they understand the shareholder expectations that management is delivering, and that that's consistent with what we all thought, and that it's highly achievable in the first year of the spinoff's life. Because the last thing you want to have is, because these transactions just generate a lot of hype, and shareholders just fall in love with the stuff. And you've just got to make sure that the company is able to deliver and meet expectations. So you don't want to set them too high.
Sure. We've had a couple of clients recently, and I can't call this a trend yet, but they call their top 15 or 20 shareholders together once they identified the board members for the two companies. And they had a meeting that they invited the top 15 or 20 shareholders to meet the new members of the board. And I think that just underlines, in my judgment anyway, that there is a real commitment to communicating with your shareholders and introducing them to the new board members, the new independent board members.
That sounds like a special needs client, though.
In terms of an edge case,
Yes.
okay.
Yeah. So I'm not so sure that every company that's being spun off, that you would see that level of interaction between your institutional investors and the new board members. I'm not quite sure. There's, at least from my perspective, not much value in that. As long as they're reputable people, they're not overboarded, they bring, good characteristics to the board. But it sounds like the situation you're talking about, there is more to the story than...
Yeah, but both of these companies, I think they can reflect what they're telling you who they are. I think you could say that they've had a lot of drama on their board, and hence they took this extra step.
Which makes perfect sense.
Okay.
I just don't think that's the normal way that people deal with it.
Yeah. How about the sort of heavy lifting, the practical work that is generated for board and management, of course, but maybe we could talk about some of the items of project management and heavy lifting here. Heidi, would you like to take a cut at that in terms of, what are the things that really need to be done, once you've decided in terms of building the board?
Well, I mean, I think there's the board has a responsibility for oversight of the process to get ready, and that's not insignificant. It's management's job to get ready, but I think the board, it's very important for the board to understand that on the day you trigger it, that it'll actually work. And that involves an awful lot of activity. Some of the things that I had mentioned before about how do you make a spin-off company successful are the same things on how do you actually affect the separation. In the most recent example with Agilent and the spin-off of Keysight, which was nearly half their business, we didn't have any, the entire board was involved in everything, and at every single board meeting we had long presentations on it. We made sure we read everything, understood everything, doing a very, very diligent job. We did have a situation where we did delegate to the audit committee some of the responsibilities around the asset and liability separation, and how you look at the credit rating of the new subsidiary, and what kind of cash, what kind of dividend should go to the parent. Those kinds of things were delegated to the audit committee to report back to the board, but otherwise the board was involved, the entire board was involved in everything. Now, Agilent has the advantage of only having an 8-member board. I think if you've got boards that are 12 and 15 people, I think that's kind of crazy in the first place, but there are a lot of companies like that, and then you might have to separate the duties.
But the fundamental decision of doing the spin, so the way I always think about it is, can the board determine whether or not the current strategy that management has with respect to the total business, will the shareholders benefit more from that or from spinning out and getting this whole new company? So that, to me, that's the most fundamental decision first, right?
Mm-hmm. Yeah, it's probably the most important part of a board's job.
Right. So you make that determination, and then it does, management really is responsible for kind of the nuts and bolts of kind of putting the transition services agreement. Because again, remember, you've acquired this business and it's now integrated, and now you have to separate it. And think of a divorce. How much time it takes to separate the assets. Not that I'm divorced. And you're talking about just a tremendous number of assets, right? From IP to employees to real estate to, just everything. Think about, it's gigantic. So the board can't be responsible for that. And I'm assuming those presentations were the presentations that management put together for the board to contemplate, correct? Mm-hmm. Mm-hmm.
Ron, any observation you have there in terms of the the large tasks that need to be tackled?
Well, one way you might want to think about it is that it's really the flip side of an acquisition. So if you think about the story we all hear, that the payoff to whether an acquisition works or not is not just that it was a good idea. It's how we integrate after the transaction closes, where the cost synergies come from, where if there are revenue synergies we can make them work. The spin-off is essentially walking backwards in time every piece of cost integration that we've done since we bought it. So think of the arrow of time starts working backwards. Those integrations have become more complicated over time. They all have to be unwound. The more successful the company has been at integrating the second business, the more complicated the counselors' roles will be in unwinding them, and the more important it'll be for the board to make sure they're comfortable with that the process has the level of detailed control that the acquisition integration would have had.
Nancy, from a management standpoint, these splits or spins or separations that you and your firm have been involved with, have they typically identified who the CEOs are going to be when the announcement's made, or is that typically evolved after the board works on it further?
It varies. As a general rule, I'd say they have somebody in mind for the spun-off company, but that can vary. It just really depends on where the board's thinking is at any given time. So.
Sure. I know as we had a prep call last Friday to prepare for this for the panel members. I know, Nancy, you had some interesting observations about a board that may be a bit stale and pale.
Yes, the expression is pale, male, and stale. So, and that's not unique to spin-offs. I think all public company boards really need to be cognizant of refreshing their board. I mean, every time I get contacted about a proxy contest now, it's first thing I look at is where does their board stand, and usually, I mean, pale, male, and stale. So, you'll become a target unless you start focusing on this. So when you do a spin, you're able to really kind of reinvent this new company. And sometimes there'll be board members from the parent company that go over. You tend not to see as much sharing, particularly if the spun-off company is a competitor of the parent company, because you have some Clayton Act antitrust issues. But use this as an opportunity to get a really good board, and hopefully you'll have less of a problem with if an activist starts calling.
Sure. I think it's pretty obvious that most people develop a sort of a matrix of competencies regarding, hopefully that matches up with the strategy of the company, so for domain expertise, certainly diversity from a gender and ethnic standpoint is increasingly important, because there are too many companies that have the problem you said, pale, male, and stale. And especially when we've seen with BlackRock and Vanguard both speak to that in the last 2 to 3 months, that they are more concerned about these long tenured directors. And so we are certainly encouraging our clients to think about not age limits, but tenure limits. And we think that's has a lot of advantages. And the way that typically happens is a policy would say, let's just choose 10 years, which I sort of like personally, but that's just me, is to say as you get ready for your 10th year, you submit your letter of resignation. And the board has the ability to accept it or ask you to stay another year or another 2 years. So I found that could be very helpful, especially if it's very dicey to ask people to leave. And I think that's one of the real difficulties that boards face. And everybody hates it.
I have a problem with that. These are sophisticated men and women. I mean, it goes to board evaluations too, which I find kind of irritating to do. But people should be able to have frank conversations in the boardroom about performance. And to me, if you don't have that ability to talk to your fellow board members and say, look, you haven't shown up for the last 2 board meetings, or you've been ill prepared, it's time to go. That the chair may want to do privately if you want to criticize them. But I just think it's a much better board to have those frank discussions rather than forced tenure. There are times where I think there are some people who should never retire. They're so good. They're just so good. And why should they retire?
Sure. No, I think everybody would agree that that level of transparency and openness and directness is a plus. But I can tell you, from my experience anyway, there's definitely a hesitation to bring it up. I think if somebody's really a behavior problem or not attending, they're obvious. But otherwise, it's very difficult. Especially if I've noticed, especially if a company's going through tough times and they've come out of it and they're doing well now. They said, hey, listen, I was here in the tough times. I want to enjoy some of the good times here. And it's really tough sometimes to ask that 13, 14, 15, 16-year tenured director to step down, not sign up for re-election. But it's just that experience. Any other experience, Ron, you've had with that, or in terms of how to structure that with the new boards?
Frankly, my sense of the hard part of this isn't the obviously underperforming director. That may be hard, but and you may look around to see who's actually going to have the conversation, but the conversation is going to take place. The harder circumstance, which is a lot of what we can all read whatever content we want into the pale, male, stale story. For me, it's a board that's no longer energized. That it's not that they're not coming to meetings. It's not that they're not having conversations. It's not that they're not reading the material. It's just that there's a level of energy that's sort of been reduced over time. And the method by which you sort of re-energize people in a particular board, how many changes does it take? What kind of people in order to have a group of people who are suddenly seeing the company in a light that is different than the existing board has had. That kind of board governance strikes me as both enormously important and enormously difficult to do.
Yeah, my experience is that too. I guess been consulting and been in the search business for 32 years, but being in organization development consulting previously. Within a major corporation, a Fortune 100 company. I guess my experience is most management committees don't have problems managing conflict. Their real difficulty is managing agreement. And they collude to fail. And this is one of the issues with the low energy. The people begin to think exactly like they don't have a richness of a diversity of thought and experience. And people make the same assumptions, and their logic is great, but they make faulty assumptions. So they can really collude to fail or follow, make Clay Christensen's mistake back in '97, the innovator's dilemma, that they can fail to identify, a new differentiator, a new disruptor in the marketplace, and stay with the cash cow too long, and allow management to without asking the tough questions. So that can be a very, very serious issue. We want to leave time for some questions. So let's stop here. We have a lot of other things we can talk about, but let me ask, if you have questions, if you could come down to the mic, and I want to make sure that we have some time for interactions with the audience. Yeah, sure.
So I wonder if you could address the question of transitional governance, in particular if you've been running the entity as a separate entity with its own internal board. As you prep it for separation, what does a board member on one side or the other or both have to think about in terms of conflict, in terms of stepping down from particular decisions, in terms of being invested in both sides of things? Just there's probably a whole raft of stuff around transitional governance that
Sure.
I've got less of a legal point of view on that than my colleagues do, that's for sure. But I think that, well, the new board doesn't exist until it's spun out. So there aren't any, even if you figured out who's going to be on the new board, they don't show up at the board meeting. But what we ended up with at Agilent was, it was a standing room only room because you had selected the new management team. And so it was like having two board meetings in one, because you would have the management team that was going to be remaining with the parent go through the operational reviews, the strategic reviews and things like that. And then you'd have a whole other set, because you still had an obligation to follow the businesses of these companies, but it was relevant for management to start to transition to be independent. And they were operating that way, even though they weren't a public company yet. So it was, we're kind of nice to have a smaller room now that it's spun off.
Nancy, do you have any guidance in terms of this in-between time before you actually have two separate companies?
So, no, I think Heidi has pretty much identified what the issues are. It's not a new board yet. The one thing that you may want to think about in kind of forming this new board and this new company from a corporate governance perspective, there's going to be a great inclination to just mirror whatever the parent has in terms of charters, in terms of protections, because there's so much else going on that you say, fine, we'll deal with that stuff later. It worked for this company, why not, this company? You may want to think about defensive measures that you want in the new company, whether it be a staggered board, preferred stock, blank check preferred, whether or not you want to keep in mind the pill on the shelf, voting, super majority voting on changes in bylaws and the articles, But you also have to factor in that once you're a public company, ISS, Glass Lewis, they're all going to start taking pot shots at you. But you may want to take those, but think about it before you spin that out. Just don't do a knee jerk of, let's just put whatever the parent has.
Let me ask one follow-up question. Any experience on the panel of the best way to build this board? Do you expand the board initially so that, I guess that may have the advantage of people get to know each other, they get an opportunity to have a couple of meetings with a common culture, or do you build the board separately? And that's typically what we recommend, but I'd like to get the observations here. Any observations?
Separately meaning no carryover from the parent?
No, some carryover, but you build them separately, and they
yeah.
meet separately and not meet together up to that point where you have to split them. Because my understanding, you have to have about 90 days of auditable results before you can actually become public. Both companies public again, so they have to operate for at least some period of time under SEC evaluation, I guess. But any observation there?
We never met together.
You never met together? Okay.
Yeah. And with the new board I'm on, Halyard Health, we never met with the parents.
Yeah, just kept it separate? Yeah, that's separate what we've recommended. Next question.
Could you please talk about, based on your experience, what you've seen in terms of dynamics and incentives that surround the compensation of the management of this spin-off company, especially given the large stock grants, which typically the strike price would be set up after 30 days, which typically creates all incentives in the world for the management to downplay the spin-off during those 30 days, and then those incentives change from day to night. So what you've seen in your experience, both for clients whom you advised, as well as your experience when you were on the board?
Ron, you want to take a shot at you? Maybe you and Nancy?
I actually want to do something. I want to add to the question because it's a really nice question, and we need to roll it back. The question I have for both Nancy and Heidi, the management of the spin-off company has got a pretty good idea who they are, and as a result, they have, for lots of the reasons you described, they have an interest in how that split takes place. And the question I have is, and it goes to shaping kind of some of the incentives you're talking about, because it requires, new management wants to be able to perform in order to cash in on the incentives. How much informal negotiation between the folks who are going to be looked at to running the spin-off and the parent are with respect to the separation issues? Because they're informal. The board obviously has responsibility to the existing shareholders. But how much internal negotiations about the shape of the way the assets are split get baked into the process?
I'm not sure I understand your question.
Okay, I'm going to be, let's imagine, I'm going to be the CEO of the spinoff. I'm betting my career and all my incentives on how well that spinoff's going to perform. A significant factor that will bear on how well that spinoff performs are what assets I get, what transition details they are, what sharing operates. And the question I'm asking is, in your experience, how much informal negotiation goes on with respect to splitting it the right way when you've got a group of executives, a management team who recognize they're going to be running that spin-off and are going to have a huge stake in its success. So it doesn't take a lot to imagine their conversations that go on about how effective.
I'm sure it's the same conversation in every one of them, and it's all about who gets more cash, and maybe some other things. But it's really about the balance sheet if you're talking about the financial aspects of the split. And at least in my experience, the spin-off company, the leadership there, the CFO and the CEO, have presumably been designated, because otherwise you're really not ready to run the show. Yeah, they lobby for it, but and they make their position, they present it, they're given the audience for it, and then the parent company makes up its mind. So I think you have the facts on the table, but the parent company decides. And in the case of the recent spinoff with Agilent, the audit committee reviewed what analysis had taken place to make sure that what was decided on was appropriate. So I don't find but yours was a little more about executive compensation, and boy, I think that, and maybe I didn't understand your question, but I just can't imagine. I've not seen any evidence of the CEO trying to game the stock price. I mean, they're so focused on getting their new company out. This is typically first-time CEO job. They're really excited about getting in there and doing a good job and getting it going and kind of gaming it to get a different level of options or grants up front. I just don't think is on the landscape.
Exercise price as well.
Or exercise price. I just don't. I don't think that's on their radar.
Well, it's kind of not what I observed as a public market investor. And I think the whole another point about the strike prices is that some companies that are pursuing spin-offs, if you look at them, there are a number of those which downgrade their guidance on the earnings. And then there is this big drop in price. And 2 months later, there is a spin-off. And obviously, the management of the parent company got their stock price is adjusted, it's restricken really, and at a lower level. And similarly for this Panco, it's also low price. So there is some empirical anecdotal evidence out there that gaming of the system may exist, and it's not illegal. It just, as a CEO, it's really my choice whether I tell my investor relations people, go out there and make a great pitch for the company, what great product pipeline which capital allocation policies we pursue. Or I can tell them, be quiet for the next 60 days. And after 60 days, go all guns blazing. So you've never seen this?
It didn't happen in the cases I was involved in. So
Nancy, any observations from your practice?
people aren't doing their job if they're doing that.
Yeah, exactly. I have not seen, or that's not been my experience, but I've heard people say that. So you're reinforcing what I've heard, but I've not had that experience with companies.
Let me add to which is that the reason these things are spun off, and I've spent many years at a company called Baxter International, which was famous for not really getting the best out of its assets. And over the years, they would spin these things off. And within 2 years of being spun off, they're 5 times as valuable as they were part of the company. And that's about to happen again with the biotechnology business that's recently been spun off. And you could easily say, well, okay, look, you're obviously underpricing this thing, and you're letting the executives fix the price so they can do well, and they want to look good. The fact is, the original management would have wanted to look good too, but proved themselves incapable of managing that particular subset of the company's assets. And at the time when they were spun off, they really were only worth what the spin-off valued them at. And it's testimony to their foresight and insight in figuring out, look, if we do spin this off, we can probably do better. That what happens when you do a successful spin-off is that the value of what you've spun off does increase. And I think there's an element of unfounded conspiracy theory when you say, well, if you do well, it must have been because you weighted the dice. I think it's you did well because you actually figured out you could do well with the right management, freed of the constraints of arguably the wrong management. It's not easy, but the fact that it works sometimes is good and reasonable, I think.
Yeah. Raj, you have any observation on that?
I mean, not specific. I haven't really seen that issue and done as well, so I think I'd sort of...
Sure.
My question is about spin-offs for large publicly traded companies, and specifically how, beyond like the proxy fight and the relationship between an activist investor and the board, the government also is involved. So, like in the case of like Jeffrey Smith trying to convince Yahoo to buy AOL, well, the SEC got involved in saying, oh, there's some antitrust issues and there's some concerns there. What in the case of, is it Nelson Peltz that wanted to split PepsiCo, where it's a really large conglomerate? Does the government also get involved? Is that also part of the equation when you evaluate how to, kind of split a company if they're large and publicly traded?
Sure. Ron, you want to take a shot at that, or Nancy?
So the SEC is a disclosure-based agency. So the only thing the SEC is worried about is, have you made adequate disclosure to the stockholders relating to the transaction? In terms of antitrust, it's Department of Justice and the Federal Trade Commission, they will look at transactions, but as a general rule, if you're spinning something out, I think it's less likely to have kind of their oversight on that. I kind of doubt that they would say, oh yeah, you have a problem now that you're spinning it out. The oversight may come later when they go and embark on an acquisition strategy. But so the government has a role. I just don't view it as a major role for a determination whether or not to spin the company or not. I don't know. Was your experience different?
No.
I was going to try to take us back to the defensive measures that Nancy began to speak about and touched upon. I think one of the big issues in spins right now is pressure against using the spinoff as an opportunity to put in place things like staggered boards or inability to call shareholders to call meetings, supermajority amendment provisions around bylaws and charters, which I think historically and in some of the large transactions that's been used as an opportunity, maybe partly on the basis that it's a new company and it's those protections are more appropriate. So there have obviously been some headline spins where that's been that pressure has been applied, and I think the companies have chosen not to use that. So I'd just be curious on your thoughts as to that trend and whether that's an appropriate approach.
Ron, you want to take a cut?
At least to frame it, I think you're exactly right. It's a big stake issue because the reality is with things like cumulative voting, removing shareholder rights, if you don't do it then, you're not going to do it later because you won't get a shareholder vote for it. If it's a big enough deal, you may do it anyway. There may be a sensible claim that in the period after, pick 2 years after you've spun it off, the company may be more susceptible to takeovers. They may not be value enhancing. So you could also imagine using those defensive measures, but with sunset provisions, that the shareholders get a crack at them 2 years later. The downside of saying we don't need anybody's approval in order to do the deal is how much lack of confidence you instill in the institutions going forward. Because what one reaction is, I have less confidence in these folks because, in fact, they were shielding themselves from the capital market. So it's a funny kind of trade-off. You got one shot at it, and there may be circumstances where, despite the shareholders' reticence about it, management still may want to shove it through.
I would at least do forum selection.
I don't view
At least that one.
But I don't view that as a defensive.
Of course, it's defensive. I think it is.
Maybe one more question.
Yeah, this question may have been answered, but I've been studying spin-offs for a long time, and in a lot of cases, not all, but a lot of cases, it always has to do with some internal friction in the company between somebody whose business used to be a pipsqueak part of the business, gets stronger, and all of a sudden there's an inevitability of the company wants to be run by two strong people, and then it has a natural affinity to demand a spin-off of some kind, so that the business that's growing rapidly has a greater chance to guide its own destiny. But in the hands of the board, in terms of the asset distribution, the assets, who gets the assets, who gets the liabilities, how does that work out in terms of your responsibility and your analysis of who gets what and who gets the better part of it or the worst part of it? Or is it everybody try to make it even, or how does that work from a practical point of view?
Well, hopefully it's a company where the assets have pretty clear boundaries based on how they operate. Otherwise, you're probably not going to be thinking about spinning it off because they are in overlapping markets and maybe just need to do a better job operating them. So I think generally they fall into most of the stuff is obvious about who gets what. But when I joined ITT Industries, I was the recipient of a bunch of assets. And what I felt happen in ITT Industries was it basically broke up, and I can't even remember the legal definition of who did what in there, but in any event, they broke up into 3 companies, which was hotel and gaming business, an insurance business, and us. And us, I mean, we were the legacy assets, and most of it was industrial manufacturing. But we had a golf course, we had a mine, we had all this crap to get rid of, And so the parent company, the CEO, at the time decided who got what. And but in broad strokes, it's pretty logical who gets what.
But sometimes that can be a good thing.
Well, in this case, it wasn't. It was a lot of effort to dump it later.
I think if you look at currently with eBay, PayPal, the boards made a position for a long time that they are very synergistic, and then the board changed their perspective. Whether it was because of Carl Icahn and others, I don't know. You might say that was the case, but it'll be interesting to see how they split there, because there's a payments business and then there's a sort of a merchant business. Their e-commerce business. So in that case, and in Hewlett-Packard, you have Hewlett-Packard Enterprise, and then you have Hewlett-Packard Inc., the printing, and their PC, tablet, consumer device business. And they do seem like relatively, separate types of assets that the board's made a decision to separate.
But what about the liabilities?
Yeah, do you have any toxic dumps or manufacturing-wise?
They got a mine.
We got a lot of those,
You got
too.
a mine?
Yeah, we got
who
the
gets
super
those?
funds, too.
Yeah, who
Of course,
gets
we
those,
caused
right?
all of it, so.
And read the bond covenants.
Yeah,
So
right.
the one that I find most interesting, and I think it's probably the easiest one to spin off, is the Yahoo Alibaba one. But that's the one that I just don't understand. They're spinning off the stock in Alibaba, $40 billion worth of stock, and a $50 million revenue business, web design, kind of like the GoDaddy side of Yahoo. And so they're going to be a closed-end fund, I guess. I don't understand that one at all. But it should be an easy one to spin out, other than the regulatory side, which I'm assuming they need to be registered as an investment company. So it'll be curious to watch, and there's no good deed goes
Good, Amber Alert.
An Amber Alert.
Great. So just one last thing, the Yahoo board just received another letter from Starboard saying, great job on the Alibaba spin. Now we want you to spin the Japanese assets. So
Yeah, continuing story here. Yeah. I think we've reached expiration date here. Dan, any final comments?